Ladies and gentlemen, welcome back to the channel. Tesla stock is coming under some pressure today. What's happening? What do you need to know? In today's episode, we're going to be going over all of your Tesla stock breaking news today, what's happening in the broader markets. Keep in mind, this week is a huge week, but it doesn't really get started until, I guess, tomorrow a little bit with the JOLTS job openings, but really on Wednesday. And I'll explain that as well in today's episode. Do me a quick favor before we get into all of this key information. Hit the like button, subscribe to the channel, and check the link out down below in the description of today's episode if you guys want to come join the trading community. But with that said, let's begin. Now, ladies and gentlemen, first things first, Morgan Stanley raises their Tesla bull case in the next 12 months to $860 per share. They continue to be bullish on robotaxis. And you could see that here that Morgan Stanley actually increased their Tesla price target today to $425 per share from $410 per share, while also increasing its bull case to $860 per share. Andrew Perocco is taking over Tesla coverage at Morgan Stanley from Adam Jonas, who now covers embodied AI. Updated models include $60 a share of value for Tesla's humanoid business, Optimus. While still a nascent market, we believe Tesla's position to be a leader in the humanoid market due to its manufacturing scale, vertical integration, access to data, compute, and energy, and leading position in real-world AI. As such, we have updated our model and now include $60 a share of equity value for Tesla's Optimus business. On FSD, he said, quote, as Tesla continues to improve its platform with increased levels of autonomy like hands-off and eyes-off driving, it will revolutionize the personal driving experience. It remains to be seen if others will be able to keep pace. Andrew finished by saying, quote, for long-term investors, we see an attractive risk-reward with 89% upside to our $860 bull case valuation, which could be in play in the next 12 months. Yeah, 12 months. If Tesla manages through the EV downturn while demonstrating progress in scaling robotaxi into more geographies without the safety driver and in winter weather-prone areas, rolling out unsupervised FSD to passenger vehicles and scaling production of Optimus. Conversely, our $145 bear case valuation is 70% downside, assumes greater competition and margin pressure across all business lines, embedded zero value for humanoids, slowing the growth curve for Tesla's robotaxi fleet to reflect regulatory challenges in scaling a vision-only perception stack, and lowering market share and margin profile for the autos and energy business. Okay. The next 12 months, I think you're going to be higher than $860 a share. Okay. Next year itself looks like it's going to be a hell of a year for markets in a good way. Inflation coming down, new Fed chair, multiple Fed rate cuts, big beautiful bill provisions kick in next year. Real estate can begin to recover a little bit. I think we're on that phase of the real estate cycle. You've been in a real estate recession for years now. And AI is alive and well. I mean, sure, is there going to be things that happen next year that are unforeseen? Probably. That are negative? Probably. That's the case every year. There's something that happens that wasn't on your bingo card. But beyond that, I see a very good setup next year for this market broadly and for Tesla stock specifically. Episode from Katie Miller's podcast with Elon Musk that is dropping Tuesday at 6 p.m. So we'll see if we get any moving headlines for Tesla stock. Tesla has just introduced charging passports, a new yearly summary of your charging. And in pretty big news today, Tesla has just produced its 4 millionth vehicle at Giga Shanghai, just 6 years after production initially started at the factory. As well as that, this is probably one of the bigger pieces of news today. It says wait times for the new Model 3 performance orders in China have extended to February 2026. So, long before we're ever, shocked by deliveries or the narrative changes for Tesla, we see that wait times extend, right? before Wall Street realizes Tesla, oh my gosh, Tesla has all of this good demand, we see the wait times extend. Okay. You're seeing the wait times extending now to February of 2026. You have to wait 3 months to even get your hands on a Model 3 Performance in China, the higher variants of Tesla products, like not the base Model 3. This is the Performance Model 3. Okay, presumably better margins as well. And demand seems to be exploding in China. Even the Model Y L, you can't get that thing until January or February as well. It's sold out completely for December. And while, the auto business is not going to be the main driver of Tesla's stock next year, in my personal opinion, it still is a very important piece of the puzzle for the Tesla story and for Tesla stock next year. Now, Tesla is preparing for a major expansion of its charging footprint in Japan, planning to build out more than 1,000 supercharger stalls across the country by 2027. Tesla currently operates 695 charging stalls at 138 stations in the country. Tesla Powerwall orders have reportedly tripled in Taiwan amid growing power supply concerns. Taiwan's escalating electricity supply challenges have sparked a sharp rise in demand for home energy storage solutions. Also in the news today, Tesla sold 73,145 vehicles in China in November, the best month since March and the second best month of 2025. Again, demand is great in China. Now, in option activity today, you have 67 different trades totaling $72 million with a positive order value of 41%. So not nearly as good as we are typically used to seeing. Over the past week, you had almost 1,200 different trades in Tesla options, totaling over $1 billion with a positive order value of 78%. So today, sharply more negative than we are used to. Tesla stock down about 3.5% at the time of recording this video, and it's not really being driven by short sellers today. You could see about 85,000 shares that have been sold short today, but that's not much in Tesla's standards. And you can see here on StockTwits, the sentiment score is 56. On Friday, it was at 61, so you're still technically bullish, but getting close to neutral. Message volume is normal at 46. Participation ratio is extremely high at 96. So there's actually a lot of people talking about Tesla today, which is not a shocker considering the stock is down 3.5%, and a lot of people are trying to figure out why. And I think it has to do with just the lineup of catalysts that we have for this week. Before we get into your, what's happening in the broader markets today, kind of answer that question, I do want to discuss your broader market news and what came out this morning. Now, I also want to say that Bitcoin has been very volatile in the past 24, 48 hours, and you are coming under some pressure to start off a new trading week, and this puts pressure on stocks as well. You can see a lot of the, risk on trade is not doing great today. Look at BBAI, one of the, high flying retail, dominated AI stocks. Good business, down 5% today, right? There's some pressure in this area of the markets, the risk on area. And it does make sense to why that is happening, and we'll discuss that in just a moment. But first, Morgan Stanley says US stocks are set for a bullish 2026. Morgan Stanley's Michael Wilson says US stocks are positioned for a bullish 2026 as market leadership broadens, earnings improve, and the labor market softens only mildly. He expects consumer discretionary and small caps, both recently upgraded to overweight, to keep outperforming, helped by stabilizing prices, stronger goods demand, better earnings revisions, and lower rates. Wilson says the Fed remains a key driver, but notes NASDAQ 100 earnings trends have strengthened since late October. With the labor market weakening gradually rather than sharply, he sees a supportive backdrop for equities, which is, again, that's part of the bull case for 2026, but it goes a lot deeper than that, right? Big, beautiful bill, some of those provisions, like no tax on tips, no tax on overtime, being able to write off auto loan interest and other things kick in about mid next year. Why mid next year? Well, tax returns. Those things are realized on taxes, not weekly. Okay. With rates coming down, real estate picks up, equity is turned into cash in the bank, and that is going to help this economy. AI is alive and well. That continues to be a driving force in the economy. We get a new Fed chair in May. Could spark or spur some kind of volatility up or down around that time, but generally that's going to be seen as positive, adding one more dovish Fed official to the committee. Oh, and inflation, that's likely to continue to come down as well. We see inflation expectations that are hitting, 7-month, 11-month lows. That's a sign of what's to come for inflation. Hassett on the Fed says we should continue to get the rate down some. Hassett is seen as the runner-up to take over the role of Jerome Powell in May. White House senior advisor Hassett says it looks like Powell has done a good job herding the cats. You can't make that up. I honestly don't know what that means, but he's herding the cats. It says that Powell probably agrees it's prudent to cut rates. And as expected today, the probability for a December 10th rate cut is really not moving around too much. It's actually up about 3% today to almost 86%. There's an 86% chance the Fed cuts rates on December 10th. Now, let me give you a little bit of a secret. The Fed always does what the markets price in, right? The Fed doesn't want to surprise markets. The Fed basically says like, hey, this is kind of what we're thinking, blah, blah, blah. Data comes out, and then the markets price in what the Fed does. Okay, the Fed almost never deviates from this. At least in the past 40 or 50 years, they have not, okay? The question really becomes, what does a rate cut look like in 2026? When do we get cuts and how many cuts? Okay, January 26th, 2026, the probability of a rate cut on this date fell about 3% today, from 26.7% on Friday to 23.4%. Maybe there's some pressure on markets from that. But we're not pricing in a cut in January. You're not even pricing in another cut in March. The probability of a cut March 18th dropped from 38% to 36.5% today. So it fell a little bit. And there's a reason for this. Now for April, this is the big change today. You're now no longer pricing in a cut April 29th. Before, on Friday, you were pricing in a cut April, okay? The probability of a cut today in April is 39.2%. The probability of a pause is 40.2%. So the highest likelihood is a cut in December and then a pause through April. For June, you're pricing in the next cut or the first cut in 2026 at 39.6% probability. There's a 25.1% chance of 2 cuts by June and a 24.5% chance of no cuts by June of next year. By July, you're again pricing in a pause. You're not pricing in a cut. For September, you're pricing in another cut at 31.0%. But the odds of a pause after the, July cut, June cut, is 30.5%. So you're pretty close here to no longer pricing in a cut in September. But if that were to be the case, you are then pricing in a cut in October. Okay, so you're only pricing in 2 rate cuts next year. That's it. 2 cuts at 30.4%. The odds of only 1 cut are 25.3%. The odds of 3 cuts at 21.1%. This is why I'm so bullish on this week, okay? Because if the Fed says, look, we're going to cut once, that's not really a big shocker. Like cut once next year. That's not a big shocker to the federal funds, the rate monitor tool here, what investors are pricing in. Investors are pricing in about equal chances of 1 cut, 2 cuts, or 3 cuts. A surprise would come in if the Fed says, yep, we're now on another extended pause. We don't plan to cut rates at all in the foreseeable future. That is a very low likelihood considering Fed Moran, Fed Williams, Fed Waller, Fed Bowman support a process of lowering rates at this point. Okay, so the question is, do we come in at 1 cut, 1.5, 2, 2.5, 3 cuts? The midpoint is probably 2. You're probably going to get exactly what the markets are pricing in or pretty close to that. Well, today, stocks are selling off and coming under some pressure in anticipation of what could happen on the Fed meeting. Probabilities for a rate cut are coming down a little bit. People tend to, prepare for the worst and hope for the best when it comes to the Fed. Not to mention the last Fed meeting we had was not a good one. That's kind of part of the bull case though, because in my experience during a bull market, it's pretty rare to have 2 Fed meetings the market sell off on back to back, right? That doesn't tend to happen all that often. And with the markets that are, expecting 1, 1.5, 2 cuts at kind of the baseline median, that's pretty appropriate here. And let's be logical. Do we think the Fed's going to give you a strong sentiment around next year when we don't even have the recent data? Okay, we get the government shutdown data like GDP and retail sales and personal spending and the jobs report and all of that coming out on December 16th after the Fed's meeting. The Fed's not going to signify in one direction or the other with a bunch of cuts or no cuts until they kind of have an understanding of what the data looks like. Now, we do get a summary of economic projections on Wednesday at 2 p.m. when the Fed report comes out. But then again, we get a new Fed chair, a new Jerome Powell in May. So you got to even discount that a little bit as well. I think long story short, we're set up for an inline Fed, which sure, if markets sell off into that or come under some pressure, some areas do, I think we're going to be pleasantly surprised when the Fed says, yeah, we still plan to cut rates to some degree next year, but it's going to depend on what the data looks like, right? Is that going to be a shocker? No. The only way we get a shocker this Wednesday is if the Fed says no cuts. And again, that is highly unlikely considering there's 4 Fed officials that want a series of cuts. So I just look at the risk reward this week as highly favorable, especially towards the risk on areas like the AI trade that have not recovered nearly as much as other areas of this market, and small caps. Small caps in this environment should do very well. Again, in news today, White House senior advisor Kevin Hassett on the Fed says we should continue to get the rate down some. He is, again, the runner-up seen on betting markets like Polymarket and Kalshi as the guy with the highest probability of assuming Jerome Powell's position next year. Kevin Hassett on how low to cut the rate says, quote, we must watch the data. And again, look at this. Kevin Hassett says it would be irresponsible to lay out a 6-month rate pledge. Again, he's saying the Fed doesn't have enough data to even make an estimate. Hence, one reason why I just said you're probably not going to get a strong forecast from the Fed. The Fed's going to want to be pretty much in line with where the markets are because the data comes out December 16th, and then you know what's going to happen? The markets are going to tell the Fed what they're going to do. If the data comes in terrible, markets are going to price in more cuts whether the Fed says they're going to or not. If the data comes in really good, the markets are going to price in less cuts with the key variable of inflation. The economic data can come in good. If inflation were to, let's say, plummet, you're going to still price in cuts. JP Morgan CEO Jamie Dimon, in some big statements today, says the consumer is fine. credit delinquencies have normalized. This is actually huge to hear this from the largest bank in the world. I mean, that's huge news today. Asset on Trump's Fed choice says, quote, "If I have to be that choice, I'll be pleased to help him." Kevin Hassett says affordability gets fixed with wage growth. Kevin Hassett says AI allows for running the economy a little bit hotter. And he says positive supply shocks should help the economy. Also in pretty big news today, Trump says, quote, "I will be doing a one rule executive order this week on AI." Although we don't know exactly what this means, it does sound like cutting red tape for AI to allow the rate of progress on AI to continue. And Trump says there must be only one rule book for AI. Trump says there must be only one rule book if we are going to continue to lead in AI. We are beating all countries at this. Kevin Hassett says there's plenty of room for the 10-year yield to go down, which is important because the 10-year is what determines mortgage rates and business loans and auto loans, basically any kind of lending out there. Kevin Hassett indicates that Trump will be messaging on the economy this week. See, look at this, okay? This would be a huge positive shock to markets. Okay, I know shock sounds like a bad word, but this would be a positive shock. Goldman Sachs sees the Fed keeping a January cut option open. David Merkel, says the Fed may cut rates this week, but will avoid ruling out another move in January. He argues the FOMC won't commit to a pause because continued labor market softening could justify another cut. With no new jobs data since September, policymakers are unlikely to limit their options for early 2026. This is what I just explained. Now Goldman Sachs is saying it, so, you know, the Wall Street perspective is coming out. But this is the only logical answer from the Fed this Wednesday, is no answer at all. And when the markets are pricing in, you know, the first cut next year in what, June, July? If the Fed even indicates at all they would be willing to cut in January, or they're open-minded, oh boy, could things get exciting. Yeah, you're pricing in the first cut in June. So imagine if we're talking, you know, 3 meetings sooner, potentially, that could spur a rally in this market. Kevin Hassett says Trump will break huge amounts of positive economic news this week. And Hassett says on Trump's AI 1 rule, says this order should help AI companies understand what the rules are. Ray Dalio, pretty famous, he's not a bear, he calls himself a realist, okay? Says the biggest AI winners will be users, not mega caps. Ray Dalio says he would invest in companies using AI to boost efficiency rather than expensive hyperscalers. He warns that market concentration and high valuation pose risks, making diversification essential. And according to a White House official, Trump's aid for farmers will come to those making below $90,000 a year. Now, this here says from a New York Fed report shows U.S. households grew more pessimistic about their current and near-term finances in November, even as inflation expectations remain steady. 1-year inflation came in at 3.2%, 3 and 5-year inflation at 3%, home price growth expectations at 3%, medical costs expected to rise 10.1%, the highest since January 2014. Despite financial concerns, labor market outlook improved with lower job loss risk and stable voluntary job leaving expectations. Future earnings and income growth expectations remain positive. The report comes ahead of the Fed's expected 25 basis point rate cut on Wednesday. And the BLS says today they will not publish October PPI report. Now, tomorrow, we do have a big set of economic data. That is the ADP Employment Change Weekly. Last week, it was estimated at negative 13.5 thousand jobs. But tomorrow, we get the JOLTS job openings for September and October. The number that matters is October, okay, because that's the latest data. The expectation is 7 million job openings. So anything higher than that signifies a better than expected labor market. Anything weaker than that signifies a weaker than expected labor market. It's actually pretty straightforward there. But again, just to reiterate, this data is really not going to move the probability for a December 10th rate cut. At this point, you're getting a rate cut on Wednesday. Okay, what it will do is move the probabilities for January, March, April, June, and down the chain. Here on the day today, the CNN Fear and Greed Index is actually coming down quite a bit from 40 on Friday, which was getting closer to neutral, to 34 today. So now if like midpoint of the fear index or fear gauge is like here, you're actually below the midpoint of fear. So you're falling quite a bit today. Market momentum is fear. Stock price strength, extreme fear. Stock price breadth is fear. Put and call options, fear. Market volatility is neutral. Safe haven demand is fear. Junk bond demand is fear as well. At the end of the day, I think today is about the pre-Fed jitters. And it's actually a good thing. It's actually a healthy thing. You want to see the markets that are a little, like pricing in less, right? You don't want to see the markets heading into a Fed meeting expecting the greatest of greatest outcomes. Every time that happens, you're going to be disappointed. To see the markets react a little negatively 2 days before the Fed is healthy. It's normal. Okay. It doesn't mean we're headed to the beginning of another crash, that this Fed meeting is going to be terrible. Obviously, there can be things that are unforeseen, but this one looks pretty clean cut, in my opinion, as far as the Fed meeting. With a lack of data, the Fed's not going to box themselves in either direction. They're not going to commit to a pause. They're not going to commit to a bunch of rate cuts next year. They're going to come pretty in line with the markets. I would expect, in my opinion, more than 1.5 cuts, less than 2.5. So right around 2, little bit less than 2, kind of right around where the markets are priced right now. That's what the Fed's going to give us. And that's going to be seen as positive, in my opinion. Now, could I be wrong in this? Of course. Maybe Jerome Powell pulls a cat out the hat and surprises investors, but that's just not something I'm expecting this week. And I think the markets are going to take it very positively. Now, we also have a big earnings for this week, okay? And I don't want to, not fill you guys in on that as well. We talked about this over this weekend. There are some other earnings that could be important this week as well, but the big one is Oracle, okay? Oracle had a lot of the problems in their long bond issuances, okay? We're talking 10, 15, 20, 30-year bond issuances during this recent crash in markets, where Oracle was basically being priced like a indebted small cap company with a very uncertain future for their 20, 30-year bonds. Interest rates went to 8, 10%. It's weird. It shouldn't have happened, okay? Oracle is going to report earnings. In my opinion, they're going to say things are fine. Things are businessing as usual. Like they're going to shock markets in a good way by saying everything's fine. The bar is pretty damn low for Oracle. And that could spur this AI trade alongside the Fed. So you're going to get the Fed at 2 p.m. and then Jerome Powell at 2:30 p.m. on Wednesday. Markets are going to react to that throughout the rest of Wednesday. And then in Wednesday and after hours, you're likely going to get a positive surprise or reinforcement that Oracle is just fine. The AI trade, the infrastructure AI trade is alive and well. And that could really create a pretty hot market on Thursday and Friday, in my opinion. We also get Broadcom earnings Thursday and after hours. Again, Tesla stock today specifically is coming under a little bit of pressure. And while there's not a great reason for this, Morgan Stanley, even though they did raise their price target, they did cut the stock from effectively overweight to underweight or to a hold. And from an algorithmic perspective, that could be something that is, moving the stock, but it's really a non-event. It's a non-catalyst. It's an opportunity if you're bullish on Tesla. The story today is the same as it was on Friday. These analysts just really don't matter. Okay. they're always chasing the ball with Tesla. Okay. It's just how it is. And I'm expecting a very strong week for Tesla stock. And Bitcoin, that's just another one of those things where we're going to have to watch it. It's been really volatile. This is the 30-minute chart. So these candles are 30 minutes apiece. It has been on the low side of 87,000 to 91,000, back down to 89,000, back up to 92,000, back down to 89,000, and back up again above 90,000. You really want to stay above 90,000. You want to get closer and closer to 100,000, but I think Bitcoin is probably waiting for the Fed confirmation as well. So this market is going to see a much larger move, in my opinion, in the second half of this upcoming week. And I think it's going to be a strong upside move mixed with a strong bull case for 2026. The Fed, Oracle's earnings coming in what I think will be much better than expected. Oracle's going to tell you everything's fine, just like Nvidia did. Oracle, I would be shocked if Oracle has some kind of like problem that justifies the bond yields doing what they were doing, okay? And then mix all of that with a year-end rally, Santa Claus rally, the tactical trade, hedge funds and institutions chasing this market higher because they're underperforming and they're underweight heading into what could be a very strong year. And you almost have a perfect setup for the remaining weeks of this year to be strong. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And check that link out down below in the description of today's episode if you guys want to take this a step further beyond Tesla stock and come invest in these other opportunities alongside us. Have a great rest of your day, ladies and gentlemen, and I will see you in the next one.